Welcome to the Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome, podcast listeners. Today we have a fantastic guest. Early in his career, he helped build an online brokerage operations for a major U.S. bank from 5 to 300 people. He then helped run operations for a large hedge fund before founding Sundial Capital Research. It's been mentioned in all the publications you know, Journal, Bloomy, Barron's, Economist, all that good stuff. He's also the president and CEO of SentimenTrader, which is a research firm dedicated to the application of mass psychology to the financial markets. Welcome to the show, Jason Goepfert.
Thanks, Meb. I'm glad to be here.
Yeah, so I think you're dialing in from somewhere in the Great White North. Is that right?
Yeah, just outside of Minneapolis. We're actually due to get snow here in the next couple of days, so a little bit earlier than usual, but the season's starting.
Well, we're in Los Angeles where they just had the first 100-degree World Series game. So I think we're sweating it out here, but we're in the air-conditioned studio, or what we like to call the studio is really our conference room with a couple microphones.
I was here in 1991 when the Twins were actually in the World Series the last time, and the day after the World Series ended, we had a major blizzard. I think we got over 1.5 feet of snow in downtown Minneapolis.
Oh my gosh.
Crazy extremes.
That was such a fun World Series. Hopefully this one will be exciting. Although the tickets prices were really ridiculous. I was hoping to slide into some sort of tickets somewhere, but it's crazy. Not surprising being Los Angeles. Anyway, we'll see. Hopefully they come back to the final series in LA and we get to go. Anyway, all right. So let's jump in. Why don't you give us a little background context? You know, you've started a few firms, but how you kind of got to where you are today, and then we'll really start to dive in on a lot of I got a lot of questions for you today we want to chat about, but just give us kind of a quick overview of how you got to where you are.
Well, I grew up in the north woods of Wisconsin, so not too far from here. Spent my summers basically scraping cow dung off of barn walls, in the winters cutting logs. So realized pretty quickly when I was a kid I did not want to do that for my living. Our family had done that for generations, so that was kind of in the cards for me. And my dad didn't want me to do it. I didn't want to do it. So they kind of really pushed me to do well in school. So pushed hard, went to school for finance and economics, enjoyed it. It really kind of fit with where my interests were. So soon after that, got hooked in with Wells Fargo. They had a couple of different brokerage units. One was the quote-unquote online brokerage unit, but it was basically just a discount broker at that time. So I started with them literally in the mailroom. And I think there were 5 or 6 people total then. We hit it just kind of as the markets were taking off. Online brokerage was becoming huge, the mid-90s there. So we hit it perfectly, and so by the time I left, there were over 300 in the unit. So that was great for me because I got to see every piece of the business from the mailroom to management. So learned all parts of it, which is a fantastic experience. And one of the things that really developed quickly for me was being able to see part of my responsibilities was the margin and option unit. So I got to see applications coming in, got to see our staff making margin calls. For compliance reasons, I had to listen to every call. And if you ever want to see emotion in the market, if you have the chance, go to a brokerage unit and sit in on some of the margin calls when the market's moving. There you will see emotion.
What sort of emotion is it? Is it anger? Is it sadness? Is it resentment? Is it panic? What was the usual kind of feedback?
It is anger and panic. Our margin clerks will get yelled at a lot. And the thing I try to stress is they're not angry at you. You're the person they can take it out on. They can't call up Qualcomm and start complaining that, their stock is dropping. I'm sure some do, but so we're the person that's facing the customer and they just, that's who they're going to take it out on. So a lot of that was just frustration with trying to come up with money or deciding, if they should sell or just what they need to do. And often, these were very quick decisions they had to make because they had maybe a few hours before we would sell out their account. So, you're adding leverage on top of time pressure, and that's just really combustible. So the thing that really stuck out to me there was, I went to school for finance and economics. I was taught that people are rational, and that was my first experience firsthand with knowledge that people are not rational, at least not all people. And so that really triggered my interest in learning more about kind of the sentiment part of it, just the emotional part of it. So from there, I just started developing some indicators in-house based on, our application flow, how many people were applying for option accounts, how many people were covering their margin calls versus selling out, and just kind of put together this little newsletter type thing just in-house for trading buddies that were working there. And that was kind of the genesis of SentimenTrader, but just kind of kept doing that until this was the very late 90s, early 2000s. Felt like I kind of had learned all I was going to learn there and jumped over to a hedge fund. Realized quickly that there wasn't really anything different there. It was basically the same stuff. There was still office politics, which I absolutely detest. So left from there and went out on my own. And because I didn't have access to the same data that I had at Wells Fargo or at the hedge fund, I was trying to find a place where I could get some of the sentiment data. The NYSE has some available, the SIBO has some available, but I couldn't find one place where it was just all together. So spent $19 with Yahoo. Yahoo had this e-commerce package at the time where you could create a website for $19. So I did that. I just threw up this ugly website that was bare bones and horrific now that I look back at it, and just kind of put some of this data together that I found online and just aggregate it into one place. And didn't really do anything with it, just kind of had it out there for my own use and a couple of trading buddies. And then somebody had subscribed. I got an email that there was a subscriber, and I was just like, okay, I didn't really do anything, and somebody's paying for this. So that kind of got the bell ringing that maybe there's something to this. And so just kind of pushed a little bit harder and got a few more subscribers. And one of the columnists from TheStreet.com, Gary Smith, had mentioned the site. And overnight, we got 300 subscribers. And I was doing everything manually at that point. Every subscriber was in a spreadsheet. Every time there was a monthly billing, they would do it. I would have to do it manually. And so I didn't sleep for days because I was trying to get all of this stuff processed, and it was just kind of a crazy time. But that was kind of the kickoff to the whole thing, that there is an interest in this, that it's a niche that people are interested in, perhaps need. There isn't really a really good source that aggregates that on the web, and just kind of took it from there. So just kind of been building it since then. And a few years ago, I took on a partner, Eric Brown, who's got a doctorate in information systems. And he's just been, that was just the best decision because he's got all these skills that I don't have and has been able to build out some great tools like a backtest engine and all the stuff that in 1,000 years I wouldn't be able to do.
Was Gary Smith the technical analysis writer? I'm trying to remember at the Street.
Yes.
Okay.
Yeah, and he was there for a long time, and then he started on Bulls and Bears on Fox Business, and I'm actually not sure if he's still there, but he was their main technical analysis guy.
I used to read his stuff religiously back in the day. Oh man, 20 years ago or whenever it might have been. Interesting. We'll have to follow up later on that. Okay, so let's jump in because I got a lot I want to ask you today. I was reading one of the descriptions on SentimenTrader on the website, and I think it's a pretty good overview, so I may use this as a jumping off point. So Sundial Capital Research is an independent investment research firm dedicated to the application of mass psychology to the financial markets. It publishes a SentimenTrader website. It focuses not on market timing per se, but rather risk management. This may be a distinction without a difference, but it's how we approach the markets. We study signs that suggest it's time to raise or lower market exposure as a function of risk relative to possible reward. It's all about risk-adjusted expectations given existing evidence. So why don't you use this as a jumping off point? Tell us a little bit about SentimenTrader, how it works, and just kind of your framework for thinking about sentiment in general, and then we'll start to get into a little more specifics.
Basically, it comes down to trend and sentiment. Trend is most important, so that always gets the most respect. Clearly, stocks, for example, stocks are in an uptrend. So we try to respect that. Even if we're seeing an optimistic extreme in sentiment, it's usually not a good idea to just go short just because there's sentiment extremes. So there's always a balance between the two. Momentum is part of that as well. Other markets aren't quite as clear-cut because they're not typically as trendy. Currencies are maybe an exception, but a lot of markets are quite a bit more choppy. So using trend is a little bit more difficult than something like commodities or maybe crude oil. They tend to chop around a lot more. So sentiment tends to be more effective or more consistent anyway in a market like that. So it depends on the market. It would be nice if there was just one indicator we could all use, one set of rules that we could all use, and that would help us outperform. But that's just, markets aren't easy. That doesn't happen. So I mean, that's the base of it, is respect the trend. When sentiment hits an extreme, pay attention. And when the market doesn't do what they should after that extreme, then you should really pay attention, because failures can tell us a lot, and people tend to just kind of ignore them.
So that's an interesting point. We'll talk a little bit about that. I think a lot of people, when they think of sentiment, they think about, the cover of the magazine indicator, the cover of a magazine, or perhaps cocktail party chatter, where everyone's talking about a particular investment, or how smart they are, how much money they're making, or vice versa on the downside. So talking about your models in general before we get to some specifics, are these geared towards more intraday traders, or is it long-term kind of tactical asset allocators? And what's kind of the time frame? Is it short? Is it yearly stuff, or is it kind of a little bit of both?
It's a little bit of both. We have indicators that are updated from anywhere from 15 minutes, every 15 minutes up to every quarter. So there's a wide range there, but the vast majority are focused on what we would call the medium term, which is 1 to 3 months. For some people, that's long term. For other people, that's super short term. So I mean, it all depends on your perspective. But for us, for a lot of the indicators that we follow, a lot of the indicators that people are familiar with, the most effective time frame is somewhere in that 1 to 3 month time frame. It varies depending on the market. Some markets move fast, some slow, but most of them are geared to that time frame.
I know the answer to this is going to be certainly not, but a lot of people, one of the challenges with sentiment is that a lot of people just want one indicator, and they would say, all right, well, this is my sentiment indicator. But I'm guessing it's somewhat of a mosaic approach, where some are kind of coincident and just used for interest. Some are probably much more specific. Maybe give us an example of just one of your generic favorite indicators, and kind of talk a little bit about it, and maybe also a little bit about that what you just mentioned, which was the ability for it to be wrong too, and what failure may mean, if that's a decent jumping off point for you.
Yeah, well, if I had to pick one indicator, at this point right now, I would probably pick the term structure of the VIX. So just looking at the price.
Oh, wow.
All
right. You're getting complicated right from the get-go. All right. Well, explain to the listeners what that means.
Yeah, so it looks at the price of the VIX, the various VIX futures contracts. And the VIX is what's commonly called the fear gauge. It's implied volatility for S&P 500 options over the next 30 days. Most of your listeners are probably familiar with it. And I mean, that's just a good way to think of it, is the fear gauge. Maybe that's not perfectly accurate, but that's a good way to think of it. When people are fearful, they bid up put options, the VIX spikes. When people are relatively complacent, the VIX is low. That's not always the case. There's a very high correlation or inverse correlation to the S&P 500, but there is some additional information there. And so by looking at the price of the different VIX futures contracts from the near term to the medium term, we can kind of get a sense of just how panicked people are. So when the near month VIX spikes higher, and we're not really seeing that further out, typically it's a sign that people are panicked right now. And that's been a real good sign that prices are near a short-term bottom, at least. Vice versa, to some extent, tops are always more difficult than bottoms are, or usually anyway. But if I had to pick one, that's been probably the most consistent one over the past few years, where if the indicator reaches an extreme, typically the market's at one turning point or another.
And so what's that saying right now? I think we've seen a lot in the media about volatility being really low. And honestly, it probably at some pretty low extremes, I would think. What's your interpretation on the way it looks right now?
Yeah, it is low. It's been low for much of 2017. So whenever that happens, people say, well, see, it doesn't work. Well, nothing works 100% of the time. Fundamental analysis doesn't work 100% of the time. So you're never going to get anything that's always perfect. So it has had some failures this year. It is more of a shorter to medium term indicator, so I wouldn't say the failures were that bad, but they were there. And recently, in the past couple of weeks, it did register an extremely low reading, meaning that people were very, very confident. There was not much fear that there was going to be an imminent correction. So we're starting to see that correct a little bit now, especially today. But yeah, it was recently at a pretty complacent extreme.
It's funny as we think about it. I mean, I this makes me recall a great Reminiscences of Stock Operator. The newest edition a couple years ago had an intro or a epilogue written by Paul Tudor Jones, famous macro trader, and he talked a lot about if he had to pick just one indicator, his basis was the 200-day moving average, which is kind of astonishing to hear, from this multi-billion-dollar fund manager that goes back to using something so simple that's probably the most famous trend indicator. And so talking about what you just mentioned earlier, where you said respect the trend, we're in an up market in the US, but at the same time, start to realize that we're having some extremes on volatility. For example, some of the lowest, I think on a couple of measures, October until today was some of the lowest volatility month and some of the lowest volatility readings ever. But you can often see volatility just bump along the bottom until the event happens. And then it for prospective investors, I think the average VIX rating is probably around 20? Am I right in that? Or is it closer to like 15?
It's upper teens.
Upper teens. Okay. So right ballpark, but it can spike to the fear is really what, like 40?
Yeah.
For panic.
Once it gets past 30, it's a pretty good sign of fear.
And then it's kind of unlimited ceiling after that. You go up to the 1987 and estimate it gets all the way up to 80 plus 100. But it's interesting because a lot of people say, oh my God, this is the lowest volatility day ever. It doesn't mean that it has to crash or that it even has to revert. It's a sign sign of the times. And so, for a lot of long-term investors, is this something that they even need to look at, or could they, just ignore it? Or what's kind of your perspective on, how robotic using these are? Like, are you actually implementing these with kind of rules-based approaches, or is it more kind of using it for color?
I use it for color. I don't do anything systematically, which, is to our detriment at times, but I do think judgment has a place. I think discretion has a place, especially when it comes to sentiment. The rise of these quant funds that just trade purely on price action or whatever metric are a little bit scary because they can't react. And in fact, there was just something in Forbes about 320-somethings that have $10 million under management, and they're trading $1 billion a day. And that wasn't all in NYSE stocks, but that would be about 2.5% of daily NYSE volume. And these guys, they had one year of trading experience, and they're turning over that much stock. That bugs me. That worries me. The experience is not there. The safeguards aren't there. And in 1987, I have no idea if something like that is going to happen again. I would not be surprised at all to see a multi-day 5 to 15% decline, in part because there's too much mechanical going on in the market. There's not enough discretion. It's not like the old days with the floor traders, and I think that's going to end badly temporarily. But that does not mean, a huge bear market. It doesn't mean anything besides there's probably at some point going to be a major scare where people have to readjust their thinking on some of the stuff that's been going on based on an extremely calm market over the past, really, 8 years.
We're going to come back to this later when we talk about crypto, but there was a great stat that there's been like 100 crypto funds, hedge funds, and the average age of the crypto managers is 20. I think it's 24 or 25. So it's an interesting sign of the times. But speaking of kind of color a little bit, I read a newsletter writer, a friend of ours we've had on the podcast named Jared Dillian, who writes the Daily Dirt Nap, and he humorously wrote a piece the other day about kind of things you see in bull markets. And he said, you go to a restaurant and you notice it's really loud and bustling, whereas in bear markets, people tend to be a lot quieter and, the conversations are much more hushed. And so I went to dinner. I filmed a Market Watch panel in Beverly Hills and went out to dinner with the hosts afterwards. And Jared, I forgot to mention, said, of this bull market, he said, one of the big signs is the restaurant. You go to a seafood restaurant, it's the seafood tower, which he says is like one of the worst possible probably things to order because it's super expensive and you don't get that much, but it's just a sign. It's very ostentatious. It's kind of like, getting the champagne at a lounge where they come out with sparklers or something. And so but sure. I was laughing because not only did my table order one, and meanwhile it was delicious. I love everything in a seafood tower as long as I'm not paying, but I saw 3 other in the restaurant. So that's a little bit of a, coincident indicator of the bull market, which I thought was funny and relevant. But That's one of the things, is you see a lot of the sentiment stuff tends to correlate, meaning, a lot of it tends to happen at the same time where you see these signs and echoes and, you mentioned that the volatility is really low. Well, often that will coincide with, an uptrend and a long bull market and also people starting to get giddy. Talk to me a little bit about some of the bullish sentiment surveys and, on your thoughts. I know there's a couple big ones. There's AAII, there's Investors Intelligence. What's your thought on these surveys in general? Are they helpful? Are they useful? Are they misleading? What's the general thoughts there, particularly with regard to, equities positioning?
I find them useful. They're mostly coincident, but that doesn't mean they can't be useful because typically they're bounded. So fewer than 0 people can't be bullish and more than 100% can't be bullish. So there is some use to that once we reach one of these upper or lower bounds where stock prices, are not necessarily bound. And usually that's a helpful feature. So I do find them useful. They all have their uses. Investors Intelligence is probably the most useful. If I had to pick one, I'd probably pick that one. But Market Vein Consensus, a lot of these services have sentiment surveys that are useful. Even some of the monthly surveys from the Conference Board or University of Michigan, they all pretty much track the same, maybe on different time frames, but they typically go up and down together. The AAII survey, American Association of Individual Investors, that's probably the most popular one, and I'm not exactly sure why. I think we follow it, but it carries no weight in any of our models. There are several issues with it, and besides the fact that it's just become really popular, which I think is with some of these sentiment surveys because it's what people are saying. It's not necessarily what they're doing with their money, and I think there's some observer effect that goes on with some of this. So, these people that are members of AAII, they're market participants. I think some of them are fairly active. They see out there that they're a contrary indicator, that if they say they're bullish, that, maybe stocks won't go up then because, people are using it as a contrary indicator. So maybe the next time they take the survey, well, they'll say they're not so bullish. They'll say they're, neutral or bearish. So I think there's been some impact on the survey because of that reason. I think we're seeing that with some other indicators as well, like the RIDEX family of mutual funds. That became a very popular sentiment indicator probably 10 years ago. Well, people became more aware of it, including the people that actually trade the RIDEX funds. So they changed their behavior. So I think that's a real danger with some of these indicators, especially the ones with smaller sample size. AAII probably has 150 to 300 people in their surveys. The other issue with it is it skews older. So if you plot the AAII survey against consumer confidence of those 55 and older versus those 35 and younger, there's a really high correlation there. So part of the reason the survey is very low, it seems like people aren't very bullish. It's just because, perhaps people who are older are not very bullish.
They're just
are
grumpy.
Younger, middle-aged.
Grumpy old
exactly.
people.
Grumpy old people. So a lot of what we're seeing in the media right now is saying, well, sentiment isn't elevated right now. There's no optimism. People hate this bull market. Just citing this AAII survey, I think, is really misleading, and it's kind of a disservice.
Well, there's two comments I'll make on the AI and Investors Intelligence. I mean, the AI, at least I think one reason people like it is it has a long history you can download, so people can go look at the numbers. But it did at least get the turns right. I mean, I think the highest bullish reading it ever had was in like January 2000, and I think the least bullish was in March 2009. So these, at least it got the extremes right. But the best interpretation I've ever seen of the Investors Intelligence was Leuthold, which I think is kind of near you guys. They did an average of the sentiment over the course of the year and then looked how the performance of stocks did the following year and found that, not surprisingly, the 10 highest sentiment years had terrible stock performance. The next year, I think it was around 0. And then the 10 lowest sentiment years had great stock returns the following year, which I thought was a pretty interesting application that I hadn't really seen. But it just goes to show that a lot of these surveys, they spend a lot of time in kind of in the middle that's not that useful. And really, for a lot of the sentiment stuff, it's only at these big extremes where it really is the good signal.
For the most part, yeah. And the AAII survey is interesting because you're exactly right, and it did mark those two extremes in the market, one high and one low. Most of the time, it does not. So, like at the 2007 peak, bullishness was not very high. It was in the middle of its range, right as the market was peaking. Optimism was much less than it was even a couple of years higher. So all through 2004 up to 2007, you saw this constantly declining peak in bullishness among this population, which is what we've seen over the past few years as well. So the survey did not nail the top in 2007. It did not nail the top in 1998 or 1994 or 1990. So using it as the end-all, be-all of sentiment, I think is really sketchy because it doesn't often give a generational high or low. Most of the time it's either in the middle or diverges from price, which I think can also provide some information.
Well, I mean, you talk about this too. I've heard you speak that, and we talk a lot about this with valuations and constituent complexity, is that every cycle is different, and you mentioned like 2007 looks different than 2000, and there's a lot of reasons why. And I think you had a comment, something along the lines of, it's always going to be different, so don't fight the last battle. Maybe you could talk a little bit about that and how the history may rhyme, but not necessarily be the same. And you got to kind of keep an open mind about what might be the next driver and the next sign of the next good and bad time.
Well, yeah, I mean, there's all kinds of behavioral biases that are geared to that, recency bias and availability bias and all of these that tell us that we shouldn't put all of our weight on the thing that just happened. But that's what we all tend to do. We look at the VIX. Well, the VIX is priced, supposed to be on future volatility, but it has an exceptionally high correlation to historical volatility. So people are pricing in the future based on what it just looked like in the past. And we see that a lot with indicators and with markets. So right now people are saying, well, stocks probably aren't going to peak because we're not seeing kind of optimism that we saw in 2007. Well, no, but 2007 was probably a once in a lifetime kind of a peak. 2009 was a once in a lifetime kind of a bottom. So you're not going to see the same kinds of readings that you saw at those turning points. There are a lot of different bear markets throughout history. There's 25, 30 of them, and each one of them looks different. Each of the bull markets looks different. They're all different lengths. They're all different magnitudes. And so that's one of the big challenges is nothing ever looks like it did in the past. You might get something that rhymes a little bit, but mostly it's going to be something different. And you look at this cycle, and you look at the influence of, you've got now the passive versus active flow. You've got all of this private equity money that's distorting some of these indicators. Look at the number of IPOs. People are saying, well, we're not seeing giddiness right now because we're not seeing this big surge in IPOs like we did in 2000. Well, no, that's because they don't have to have an IPO. There's all this private equity money. So if you're looking for that indicator, you're not going to see it. You're probably not going to see it for years, if ever, because these companies are not going to go public. So, each time is different. You have to use a little bit of judgment and just kind of take a weight of the evidence approach and see if it adds up.
Interesting. And it kind of goes back to thinking of everything as a mosaic. Talk to me. So we have a little website we love to use called Favestar that lets you rank someone's all-time most popular tweets. So I'll read a couple yours in a minute. But talk to me about Twitter in general. Is that something that, is kind of a new entrant? Is that something that's useful, you think, as a sentiment indicator? Or is it something we should maybe be a little cautious about?
Twitter is a wonderful, horrible thing. It can be the best tool out there in terms of real-time collaboration with people that you would never be able to collaborate with otherwise. And it also attracts kind of the dregs of human society. If you go and look at the comments of almost any tweet, you just kind of want to give up on everything. So it's useful kind of as a broadcast mechanism. It's becoming more difficult to use as a collaboration tool. And I think using it as a tell on sentiment is really dangerous because we self-select our Twitter universe. We determine who we're going to follow. And we tend to kind of follow the people with a similar mentality as us. So, if we're generally optimistic, typically we're going to follow people who are optimistic. And so if you use their Twitter stream as a rate on sentiment, well, that's really skewed because you're basically just seeing optimistic people, and vice versa. Vice versa is probably even, kind of the zero hedge community, I think, is even more dangerous. But so trying to read sentiment based on this self-selected sample is just fraught with risk. I think there's more interest and more use in having kind of some kind of a machine learning algorithm that learns sentiment on Twitter, uses the language of tweets. In fact, my partner, Eric Brown, did his doctorate on that. And that can be useful, especially on individual stocks, some sectors, and even kind of the broader ETFs. But again, there are funds that have been developed to trade based off Twitter sentiment or StockTwits sentiment, and they've really struggled because it's the game theory thing. Well, if these other funds see this fund performing well, maybe they're going to populate Twitter with some fake tweets, which is super easy to do. So even using it in a quantified manner, I think is really challenging. There is something there. It's hard to use.
I think there's a lot of insight there where, most of the listeners can relate to even the election, and everything that's gone on in the past year.
Absolutely.
And talk where a lot of people use Facebook and they have this echo chamber of following other people that are in their own universe. And so they live in this bubble of whether it's political views or religious views or market views. It would actually be interesting to try to combine maybe 10 or 20 of the biggest perma bears personalities on Twitter, and then maybe 10 or 20 of the biggest perma bulls, and maybe you could talk to your partner about this, and then get them to say study, all right, we're going to do a word cloud of the all the people they follow or that follow them, and then all the word cloud of all the people that are the perma bulls, or study, and you see, I'm sure you'd see just a totally different conclusion. And that's the hard part about listening to market news in general is I'll find myself, and this is why I'm a quant, is I'll find myself reading a research report. I just read one the other night that we're sending out to the Idea Farm, and I spent the entire time thinking, oh my God, the conclusion is you have to sell everything and buy a bunch of puts. That's the emotion I felt. And thankfully I'm a quant again, but so I don't have to worry about it. But you can see why people who consistently get that IV drip of good or bad news or whatever that just reinforces it, it's tough. You had a great example. It's actually one of your most popular tweets was you said, this was a funny one. It says, this is likely incomplete, but you said it's paid to be a buyer when CNBC pulls out it markets in turmoil feature. Do you remember that tweet?
Yeah, and they've kind of stopped doing it after that. And I had kind of a little tip with some of their producers that were saying, well, you omitted some of our specials. And I said, well, so send me the dates, please, because I went through their feed. I went through their Facebook accounts of all of their personalities, and I'm fairly certain I've got all of the dates that they ran one of these specials. And invariably, they ran it, after the market declined a few percent. Well, partially this just works because it was a bull market, but almost invariably when they ran one of these specials, the market turned around that day or a day or two later. So, we're seeing something now with President Trump. He very much loves to tweet after the Dow just hit a new high, after, it's been on the news. His buddies at Fox News are giddy about it, and so he'll tweet a screenshot. Well, there's a pretty high correlation between the volume of his tweets and future market performance, even though it's been a short time period. But even if you look at just the average return, I think the most consistent was 4 days later. There's a stark difference between how the market performs after he tweets about the stock market and when he doesn't. It performs much better after he doesn't tweet. So, some of the stuff is just kind of for fun, and you can't really necessarily use it for, especially for investments, but maybe even for trading. But, like you said about a mosaic, it all kind of comes together and gives you a bigger picture of the overriding sentiment out there.
That's really funny to talk about Trump tweets because I don't really bet on sports or anything else, prediction markets. But when the Mayweather-McGregor fight came along, I had done a quant study. I was joking with friends. I said, here's all the prop bets. How long is the national anthem? Who's gonna wins the fight gonna end? And there was a prop bet on how many times would Trump tweet during the day of the fight, and it was at 6.5. And I went and studied his last 6 months of tweets and found that his average tweets per day were 12. And then on top of that, they included the POTUS account. And so I said, this is an amazing bet. For whatever reason, the sports book isn't accounting for how many times he's going to tweet. And then on top of that, and this is if you're a good fundamental stock analyst, you say, okay, what does the market know? What is the market not accounting for? Well, this was also the weekend that the hurricane was coming into Houston. And so I said, oh my God, he's going to tweet 500 times, and I'm going to bet everything I have on this. Of course, I'm not, because one, Vegas won't take the prop bets on this, and if they do, they max out $100. And so then I was using one of my friend's online sports books, because of course I would never use an online sports book, but
no, of course.
One of my friend's online sport books, and then you can't bet that much then because it's probably located in Aruba, and then it's going to disappear into the ether. So I bet. Then of course what happens Trump tweets like 5 times and then just goes dark and then just doesn't tweet. He goes to bed early, I guess. And although the POTUS account retweeted like 10 tweets. And so I of course, was like, hey, this, according to Twitter's terms of service, a tweet that's been shared is called a retweet. So I'm like, this is a tweet. And then, of course, you know what happens. He wakes up the next morning and literally tweets like 75 times. But it's such a great example of, sure things and markets and bets and, why I'm a quant.
That fight is the best example of sentiment I've ever seen, because I think it was the day before the fight. I'm not sure if it was ESPN or what service had it on, but they had a bar graph of the number of bets on Mayweather versus McGregor, each one, versus the dollar amount bet on each one. And I forget the proportions, but the vast majority of bets, the number of bets, were placed on McGregor. The vast majority of money was bet on Mayweather. So you saw basically a few large, smart money people betting everything on Mayweather, and the hoi polloi betting on McGregor.
The bet size was like $100 on McGregor and like $100,000 on Mayweather.
Yeah, absolutely. Yeah, so when you're looking at the difference between smart money and dumb money, there's, in my entire career, I've never seen a more stark divergence than the betting on that fight.
And meanwhile, Meb's just sitting here. So I set up alerts on my phone for Trump tweets, which I haven't turned off yet. So I still got to go. That reminds me to go turn that off, because I get alerts all day long on these insane tweets. All right, let's go back to markets, investment markets. I'm going to bounce around a little bit. You guys do anything with margin levels or commitment to traders at all?
Yeah, both. Margin is, it's fine. We track it, but there's typically not much information there. It goes higher when stocks go higher and goes lower when stocks go lower. So to me, the most use I've seen with it is looking at the rate of growth in margin debt versus the rate of growth in an index. We use the S&P, but it doesn't really matter. So what you saw in 2000 and 2007 was you saw this huge growth in margin debt over and above what could be, I guess, rational versus the growth in stock. So we haven't seen that even to a close extent since then. So, when you see, or the idea that we're not seeing excessive optimism, that would be one example of it, just that we're not seeing the rate of growth in margin debt that we saw in 2000 or 2007 relative to what would be rational. So there is some use to it, but the vast majority of the time it's just does what it's expected to do. And yeah, the level is high. There's not much cash in these accounts. So when you look at kind of a net worth figure, take the cash balances from the margin debt, it's hugely negative, even when you put that in relation to market cap. But historically, that's not a great indicator. It wouldn't necessarily have gotten you out in 2000 or 2007. And prior to that, in the prior decades, it was really random. It was basically useless. So that's one of those indicators, again, that's pretty popular. The media likes to cite it. Fearmongers like to say, well, debt's at all-time levels. That's all true, but I don't think it's that useful.
What are some other popular ones that you think are just kind of bunk, or that you think that the media loves that's really just kind of worthless?
You'd mentioned magazine cover indicator earlier. That's one, too, that every time people see a cover, they think, well, you got to take the other side of that. It's just, markets are not that easy. It's not that easy. I'm sure this has been done before, but I did a study of every Barron's cover. I don't know how far back I went, as far as I could, years and years and years. And it was mostly a non-contrary indicator. I think their success rate was between 50 and 60%. It was fine. So the market typically did what they thought it was going to do when they put it on their cover. The only one that I've seen that's really convincing is the Economist cover. And to their credit, they actually ran a story in the Economist about how their own covers were contrary indicators. They had supplied a historical feed of their covers to a couple of researchers, academic researchers. They studied the markets over various time frames, and they found that it is actually a pretty effective contrary indicator over the next year. So again, it's one of those things that's pretty popular. You hear a lot about. Mostly it's useless, but there are a few isolated examples where it can really help.
All right, I'm now going to ask you about kind of how the world looks today, and we're going to bounce around to a few different asset classes, and we'll see if you have any thoughts on sentiment on these. And for a lot of them, the answer may just be, meh, where there's nothing going on. But let's start with the biggie, U.S. equities. What kind of a lot of the indicators say now? What's your suggestions on the positioning as far as length of this bull, and what's your takeaway?
Well, certainly optimistic. whether it's overly optimistic is questionable. There are a couple of things that are holdouts. People will cite the AAI survey or something like that. That has no weight with me. But the thing that I'm really confused is fund flows. When you look at the flow of funds into equities or out of equities, we're not seeing really even optimism, and it doesn't fit with almost everything else that I'm looking at. And I don't know the reason. I don't have an explanation for it. It's just one of those exceptions that's a big exception to me. So I would classify it as optimistic. Typically, when you've got levels like this, returns going forward are subpar. The thing going for equities is momentum. And so I've done a ton of momentum studies over the past couple of months, really. And they're extremely consistent in that when we see the type of momentum that we've seen in recent weeks and months, it's very rare to see a big decline going forward. It's a little less consistent in the short and medium term, but longer term, 6 months to a year, it's really rare to see even a minimal decline. So you've got kind of a battle there between extreme sentiment and extreme momentum. Typically, shorter term sentiment will win out, so you'll see subpar returns. Longer term momentum will win out. So acute, I would say, some kind of a decline that wears off this excessive optimism, but then another rally that satisfies some of these momentum studies.
So summary is more Trump tweets to come. All right. What about two other favorites of the AAI crowd, bonds and gold? Anything going on there?
No, I would say meh for both. Bonds, we had seen a lot of really built up pessimism early this year, February, March, and then that returned to optimism in August. Since then, it's just kind of been wearing off. Gold just has not been doing much. The price has moved, but sentiment has been kind of stuck in neutral. And, when sentiment is stuck in neutral, there's just not a lot of information there. So just not much of an opinion on either one.
All right. Next, are there any asset classes experiencing kind of extremes? I know there's been some in the past few years that have gotten whacked like energy did. Anything that comes to mind?
Yeah, energy was one of those setups you don't see very often where everything came together. This was in early 2016. Metals and mining, that was another sector that just was kind of everything was coming together. I think we're seeing something very similar right now in commodities. And commodities is a broad group, and it's hard to just say, well, commodities, they move. There's not necessarily a whole lot of correlation there among them. So, but you look at some of the soft contracts like cocoa and coffee and especially the grains, and the kinds of sentiment readings we're seeing now are similar to what we were seeing in metals and mining and energy in early 2016. So if there's one asset class that I was excited about from a longer-term point of view, something that an investor would probably be interested in, it's that. It's the kind of the soft commodity complex. And that's not really easy to take advantage of. There are funds like DBA that are geared specifically towards that, but then you're dealing with, futures roll and some of these other issues. Double Line has a good commodity fund, but that's not really geared towards that. It has some other features to it. A lot of people like to invest in the companies instead of commodities themselves, but then you look at commodity stocks and they've already run up. So it's kind of a hard place to be, but if I had to pick one, it would be a fund like DBA that's more geared towards the actual contracts of some of these softer commodities.
It's funny. For being someone who's been going to a lot of these conferences in both retail and institutional for the past 20 years, you see a lot of themes. And certainly in the mid-2000s, commodities was like the headline panel on every single conference where institutions all of a sudden were waking up to commodities. Oil was at $120 a barrel. And, a couple of very influential commodity papers started coming out in the mid-2000s. And everyone, of course, rushed into commodities. And, of course, what happened? Commodities have since done very, very poorly. And then you've seen the opposite in the last handful of years. You never see commodities as a topic on any of these conferences. And they're kind of universally hated. And a lot of institutions are selling their commodity positions. And, it's so funny to see this sort of rinse-repeat sort of environment. But, yeah, I think to me, also, anytime you have an asset class that's down multiple years in a row is usually a time that it starts to get sort of interesting. And a lot of the historical studies show that it's usually a great time to be building a position as well, and starting to see a lot of negative sentiment there. But it's perking up in a few areas. Base metals have had a great year this year. But it's funny, I think a lot about one of my buddies, Steve Sugarud, talks about, collectibles and investing and thinking about what the next generation may really care about. And gold and precious metals to me is an interesting one because, at least in the US, I don't see the younger generation really caring at all. But I also don't know that the price is determined globally, that's really the use case if it's not totally determined by China and India at this point. Anyway, that was a long ramble. It wasn't even a question. that was my favorite investment cartoon is one of these black and white cartoons, and the guy finishes his speech, says, "We'd now like to open up the floor to questions short speeches designed as questions." So my question wasn't even a question. It was more of just a statement. Random. Okay. So talk to me. One of your other great tweets, one of your most popular tweets, was you overlaid the number of internet funds with the number of crypto funds launching on two different time series. So one was the late 90s, obviously, with internet funds, and now with crypto. What are your thoughts on that space? Is that an area that is seeing kind of crazy sentiment? Is it hard to measure? What's going on there?
It's extremely hard to measure. So, I mean, we're in early days with that, even though it's been around for a few years. We're not seeing the kind of data around it, even though it's, which is weird. You'd think there'd be more data, but there's less than there is on most other markets. So getting actual sentiment data or positioning data is really difficult for that. It's something I'm always looking at and just not having a lot of success right now. But if you just look at some of the anecdotal stuff, the number of fund openings, it tracks very closely to the late 90s. You look at the name changes some of these companies are going through, and then their stock takes off. Well, that's very reminiscent of anybody that lived through that 1999, 2000 time period. We saw the exact same thing. You look at what Overstock yesterday announced some initial coin offering. So a lot of these companies that are outside of the space trying to take advantage of it, and people are bidding up their stock to crazy levels, that never ends well. I can't think of one time where that did not indicate some level of froth. And just, you look at the blank check companies, just people throwing money at these companies, assuming that they're going to do something in the blockchain space with those funds. It's all tracking very similar to what we saw in the late 90s with internet stocks, and it's probably going to end the same way. I mean, I have no inside knowledge of blockchain. These guys are much smarter than I am. I think the underlying technology, much like the internet, is going to last. It's going to be potentially even revolutionary. Most of the stocks are going to be worthless. Most of the coins are going to be worthless.
So you're saying that you shouldn't be following Paris Hilton and Mayweather, and who was the other actor that came out? I can't remember. On promoting
probably
the
not your best bet. Yeah.
All right. Well, shoot. It's interesting because that space, it reminds me of in the mid-2000s, there was a huge interest in SPACs, special purpose acquisition company, where these blank check companies would raise $100 million, $1 billion, and then just go find someone to buy. It's such a strange, structure where people would invest in this management team that didn't even have a company yet, and they'd go out and find someone to buy. That has kind of gone away. You don't hear about SPACs hardly at all anymore. I guess they've taken their place with ICOs. All right, so talk to me. I want to hear about a little going back in time, a couple examples where you may just have some fond or really terrible dark memories. What sort of historical sentiment indicators do you look back on at a point in time and say, wow, that was just really a perfect setup or example where maybe one indicator or a whole slew were firing and it ended up being like a really good call? Are there any particular examples that you think are great examples of sentiment just working fantastic?
Yeah, I think last February, so 2016, that was almost perfect. I mean, it wasn't that much of a correction. Ned Davis and some of the other firms will call it a bear market, and that's probably accurate because if you look at the median decline of most stocks, they were down 20% or more. So, even though
I think the S&P got to like 19.5 or something.
Right. Which is so stupid to say, well, we weren't in a bear market. It just being so inflexible like that, I just think is not a good way to go. So assuming it was a bear market, we saw a lot of indicators that were just panic-ridden, and they pretty much nailed the low that time. So, sometimes it works perfectly. Sometimes, even like at the bottom of 2009, a lot of the stuff had lined up. A lot of the stuff was showing extreme, okay, this is the end of a bear market kind of stuff. And then you saw something like put-call ratios, which are very widely followed, and they were extreme optimism. So, again, you kind of have to take a mosaic approach, because if you only follow put-call ratios, you would say, well, clearly people are way too optimistic and we're not at the end of a bear market. But markets change, and maybe people were using some kind of a stock replacement strategy and buying call options instead of holding the capital in stock. So there's always exceptions. So I would say that's probably one of the most stark examples of not relying on a single indicator. Otherwise, you would have missed a huge opportunity. In 2016, then you've got something where I'm sure I could find an exception, but almost everything was lined up at that point, saying, okay, this is probably a really good buying opportunity.
That's interesting. The it's funny thing about sentiment, because when it lines up, it's usually it's the exact opposite of what people want to do. And the example I give is, over the past 5 years, we've been giving kind of speeches around the world on valuation and stock markets, and have had sort of the same message where we say, look, the U.S. is expensive and getting more expensive. That's usually pretty unpopular in the U.S., but no one cares. And then I say the rest of the world is much cheaper, and a lot of these countries are really cheap. And I'd been giving the talks in a lot of countries where they were expensive. And so finally I'd given some talks a couple summers ago in Eastern Europe in areas that were really, really cheap. And I was so excited because I said, finally, I'm going to have a popular talk and the room's going to love me. But I went and gave the talk and it was just silence, and I said, hey, look, you have this really cheap stock market. It should do double digits. Aren't you excited? And everyone they didn't care because they'd already experienced the loss. And so when you're down 40, 60, 80%, it's kind of a no duh. Like, obviously this is probably cheap, but nobody has any money to be doing anything. And on the flip side, like in the US, if you think about the mid 2000s real estate, or the late 2000s or 90s with internet stocks, is that, no one wants to sell at that point. They're like, what are you talking about? I'm buying my fourth house to flip. I can't sell now. This is when I'm going to make all the big money. So it's an interesting, challenge for a lot of people when the sentiment lines up to actually pull the trigger and follow through with it, I think. But that's what makes it probably so worthwhile.
Sold your house in 2005, and then your buddy just bought a boat because his home equity went up another $100,000 in 2007. You're going to feel like an idiot, and that's really painful. And if you buy too early when everybody else is panicking and saying, oh, you can't buy, again, you're going to feel like an idiot. That's really hard, and it takes kind of an iron constitution to be able to wade in on either side and go against the crowd. And it doesn't always work out. Sometimes your buddy is right. Maybe we're seeing that right now with Bitcoin and some of these other things that are taking off, and some of us from the cheap seats are just kind of giggling, and maybe they're the smart ones. But historically, probability-wise, probably not. And all we can do is play with probabilities. And
historically, buying investments that don't have any cash flows has not been a great trade. But it's funny, you'll see the Bitcoin on Twitter where people will go find these poor souls who will tweet something like, man, I should never have sold my Bitcoin at $30. Now it's at 100, 4 or 5 years ago, and now it's at 5,000. Yeah. They'll retweet them. And,
right.
And these poor, talk about the FOMO that generates, where a lot of people are like, I can't sell my Bitcoin now. It just hit 5,000. What if it goes to 10 or 20 or 50 or a million? And that's the sort of behavior you see. But again, like, that's what bubbles are. People make a ton of money in the final stages of bubbles, and whether Bitcoin ends up at 50,000 or 500 or zero, who knows? I'm like you. I'm sitting in the cheap seats eating popcorn and enjoying watching it, but not something I really want to participate in. Okay, so are there any asset classes or sentiment readings that you think are particularly interesting that I'm leaving out? Is there anything that we have? And we've done a pretty wide global coverage. Is there anything that's on your mind or that you're working on that you think is particularly notable?
Yeah, I mean, most people are interested in stocks number one, bonds number two, and gold probably a close number three. And like I said, those latter two, they're just, I don't really see anything interesting there. Stocks are interesting, but conflicting. And like I said, commodities probably is the most interesting one from either perspective, but particularly a long perspective. I think that's where opportunity on a risk-reward basis is probably the highest. Within stocks, again, there's a lot of just mixed readings or neutral readings. Among countries, you look at Qatar. If you take a 50-day average of an optimism index that we calculate, that's really low. It's probably the lowest it's been in 4 or 5 years. And we don't see that very often with countries. So some of these Mideast countries are getting pretty oversold in terms of excessive pessimism. But other than that, there's just a lot of it's just really mixed.
I mean, the way that we think about U.S. stocks that I've been talking about, I say, look, this really great long bull market, and people kind of realize that stocks are probably expensive, but they just don't know what else to do. So they end up having kind of going back to the old do what you say, do what you actually do. If you look at the percentage of household net worth in stocks, I think it's the second highest it's ever been. And usually that alone is also a pretty good indicator of future returns. But I think it's a scenario of they just don't know what to do. And so it's like an uncomfortable long. And so it'll be interesting to see, when markets start to decline, how that sentiment changes from being kind of regrettably long and invested, where they don't really want to be long, but they don't know what else to do when it starts to decline. Who knows? Every bull and bear has a different personality, so it'll be interesting to see how it plays out.
Well, you just had a great paper about using CAPE as kind of a timing mechanism, and even if you got out in the early 90s when CAPE was really high, you could have done well by switching into some of the lower valued countries. And with so many opportunities now, more than we've ever had before, investing within the U.S. market, outside of the U.S. market, people have never had so many options, which can be bad because you get kind of a paralysis by analysis situation. But there are other opportunities. You don't have to be invested in the S&P 500 spider. There are thousands and thousands of other opportunities, and not all of them are really expensive. And
that's the hard part. We often say it's tough to be asset class agnostic, because it's familiar and warm and fuzzy to be investing in the FANG stocks or everything in the U.S., but really the world is your oyster. At least that's what we say. So listeners, start to look into Qatar and the ags and everything else on the menu of investment choices. Look, I would love to hold you for a long time. A couple more short questions, and then we're going to have to let you go. Do fundamentals ever play a role in sort of your analysis when you're thinking about sentiment? Is it something that, if they do you look for agreement or disagreement or anything else, or is it something you kind of mainly ignore?
I do look at them personally. I don't really discuss it very much. I think people can get much better information elsewhere. So it's something I think about. It's something I consider. But everything, if you're looking for a comprehensive investment outlook, I think you need to tie it all together. I think the fundamentals are important. I think the technicals are important. And I think the emotional side, the sentiment side is important. So, like our mutual friend, Steve Shigerud, he looks for something that's cheap, hated, and in an uptrend. So when you kind of fuse all of them together, I think your odds are much better. So it's not something I really discuss much. It's important. I mean, of course, the fundamentals can be important, but a lot of this stuff goes together as well. If you're seeing excessive pessimism, well, it's because the fundamentals are poor and the valuation is probably low. So, when you look at one aspect, it ties into the other aspects as well. So typically they confirm each other, but it's hard to time when fundamentals are, at their worst point or their best point. And that's where sentiment and to some extent technicals can help you with that part of it.
Tell me, this is a question we always ask podcast guests, and is thinking back to your own personal history, do you have a most memorable investment or trade? And it can be positive, it can be negative, it can be whatever it may be. But when you think about kind of your lifetime in investing, is there one that particularly stands out?
Many. I will give you my worst, because it's, the pain is actually still raw, even though it's been for 3 years actually. So this was, I think it was June of 2014. We were having one of those times where everything was lining up. Everything was pointing to stocks were probably peaking. Not a bull market peak, but just there should be a correction looming. And I literally mean everything. Every single thing I looked at, every kind of analysis I do was saying we should have at least a 3 to 5% correction. So like an idiot, I violated all of my rules. I bought the worst thing you can possibly buy, which is a volatility ETF. I know all of the caveats about those. I know the weaknesses, but I was completely convinced that we were going to see an uptick in volatility imminently, and I was completely wrong. So I think this was in June, and the market kept ticking higher. Volatility kept ticking lower to where it was getting to historic levels. And so I think I managed through mid-July and ended up losing 22% of the trading account that I was using for this. And soon after that, of course, the market actually did have its volatility event, and I would have made out well. But at some point, you have to reach a pain tolerance and get out. So, the lessons from that are, well, there were many, but I violated everything, all of my trading rules. I let the loss get way out of hand. I used an inappropriate product. I became somewhat emotional, not really. I mean, I think if you look back at some of the stuff I've written, I think it would probably be hard to tell that I was actually suffering a pretty big loss in that trading account. But yeah, that really sticks out as something to never do again.
I'm laughing not because of your story, but Jeff is over here shaking. My co-host is shaking his head, and I think he was with you in that same trade. So it looks painful on his face as well. I don't remember if we asked you this question or not. If I did, I apologize. Do you have a single favorite sentiment indicator, like your own pet personal indicator? If you had to just pick one.
Yeah, ironically, it's one of the indicators that got me into that trade. It's the VIX term structure. So just looking at the difference in the various VIX futures contracts, and that was one of those times. It had basically a perfect record up to that point. So when it got to that level, volatility always jumped immediately, and so that's one of the reasons I had gone so heavy into this trade. And it teaches you humility. The market will teach you humility over and over and over again.
I wonder what's the lowest VIX you think we could print? I mean, I think we're already down to a 9-ish and change. Is 8 even a possibility? Is that something that, I mean, we're in a world of negative sovereign bond yields, so who knows, anything's possible.
Yeah, if you would have told me a month ago that in October the VIX would be, in the low 9s, I would say no, never.
Yeah.
So never say never, because, and especially now with so many products tied to the VIX, who knows? It could be screwy, and we'll see readings that we've never seen before. Maybe it can go up to 200 because some of these, products are focused so tightly on this one niche, and we're going to see readings that we've never seen before.
Well, good. We have a tail risk fund, so I'm we're betting on it to some degree.
Smart move.
Jason, it's been a blast. Where can people go to find you if they want more information on your work, what you're up to, what you're tweeting about? What's the best sources?
Yeah, just SentimentTrader.com. There's a blog on there with some free stuff, or just Twitter at SentimentTrader.
Jason, thanks so much. It's been a blast.
Thanks, Matt.
Listeners, we're going to post all these show notes, links to Jason's site, maybe some charts, all the stuff we talked about today, because there is a lot, and we'll post it up online. Thanks for taking the time to listen, everybody. We always welcome feedback and questions and snacks and anything else you want to send us for the mailbag at feedback@themebfabershow.com. You can always find the show notes, other episodes, mebfaber.com/podcast. Subscribe to the show on iTunes. If you're enjoying the show, hating it, whatever, please leave a review. Thanks for listening, friends, and good investing.